Hey, how you doing? So, chatting today to Alex Fatuliaj from Simplicity Consultancy about tokenomics because I don't know, man. I feel like every project wants to include some sort of token, and nobody really thinks about it. And so, Alex is going to run us through
Yeah.
the good and the bad of tokenomics and what you should think about. So, tell us a little bit about yourself, what you do, and how you help people.
Yeah, of course. So, very quickly, very brief rundown. So, I've been in crypto since 2017. Um, Trading, investing, researching, educating our people. And then at the start of last year in January, so at the start of 2022, for 8 months, worked at crypto VC and incubator. And both me and my co-founder, we worked there as well. And we realized that we don't really like the way that tokenomics are being done. It's mostly copy and paste, right? No one really knows how tokens are meant to be implemented correctly, like what tokens actually are. So we decided to use our economics degrees and basically revolutionize the way that the space sees tokens. And yeah, we launched Simplicity Consultancy. It's been coming on to the 8th month now. And yeah, we just designed the token economics for crypto projects. Long story short.
Cool, cool. And so, when we finish this off and all that, I'll get some links and stuff up and drop it down. So if anybody needs help, they can easily
Yeah, sure.
find you. But what is it? It's simplicity.xyz, right? It's the website.
The website at the moment is we're rebranding into Simplicity Group because we have some other
Okay.
ventures that we're all putting under one roof, basically.
Got
But
it.
current website is simplicityconsultancy.net. But
Okay.
I think LinkedIn probably is the most like updated thing. So just search Simplicity Consultancy, or depends on you're listening. It might be already Simplicity Group. And yeah,
Okay, cool. I'll add links into all of the description, all that, so it's easy to find you. But I guess we'll kick it off with for the basic, like absolute basics for the idiots like me, kick it off with what is a token, basically. So super simple terms, if we could.
yeah. The way that we see tokens is borderline philosophical in a way, but also very forgot the word, but like it's very realistic, right? Fundamentally, a token is just a means to transact value, right? It's a vehicle, and what that value is very different depending on what project you are. For example, in layer ones, your token is used to basically stake collateral, so that then in case that you are a bad actor, your collateral gets slashed, right? So the value there is basically security in a way, right? However, if you're like let's say you're a social media platform and you want to, I don't know, reward users for selling their data, right? So you then transact the value of that data with the token, right? Rather than giving the users the dollars that the advertisers are paying you or whoever, you give them the token instead. Now, basically, that's the general gist of it. And fundamentally, understanding what necessitates the creation of a token within your company, basically whether it's an L1, like a governance token, whether it's this, whether it's that, whatever it is, that already will put you on the right path to creating a token that actually makes sense. And that is something that a lot of people just miss. They just create a token for staking, governance, and rewarding users, but they don't know who they're rewarding. They don't know what the governance is going to be. They don't know why they're staking. It's all a fugazi, as they say in that one great film. But yeah,
But I guess that's the thing, though, isn't it? Because it's and this is a problem I see with so many of the brands in the space and everything. They just sort of, as you said earlier, copy and paste it. They see somebody else has got massive growth
yeah,
by introducing a token with favourable staking rates, and they're like, oh, we'll do that because it gets a ton of users. But I mean, we'll get on to sort of the utility of it and all that later on. But I just kind of wondering, so it's that the token is that transaction of value, basically allows you to transact value with the users. But then, how does that kind of work in terms of the brand and the users on a basic level?
What do you mean, sorry?
So it's a transaction of value, but then how would it actually work in terms of that relationship between the brand and the customer?
Oh, right, yeah. So it very much depends on what your project actually is, so like what your company actually does. But let's assume that it's literally just like a brand, right, as you said, and they want to reward the users. The token is purely meant to replace whatever vehicle was already in place that you're rewarding users with. And to put it into a very simple example, for example, you go on booking.com or you go on, EasyJet or, United Arab Emirates, wherever it is, you have these like points on the platform, right? And these are points that the users can collect, that then they can exchange them for discounts or whatever. Now, instead of having points, you can have a token that is also able to be sold on an exchange for dollars rather than only be exchanged on your platform for like special benefits. So you already have something there and you're just tokenizing it to add, like liquidity or to add a way for users to sell it elsewhere, right? So that's one example. Another example is, for example, if you're trying to reward users who sell their data on your platform, and obviously you're rewarding them with the revenue that you're making from the advertisers or whoever that is buying that data, right? So you can do that in dollars, sure, but I think there's I'm not a lawyer, obviously, but I think the regulations around that are pretty a bit more tight. And also, if I'm selling my data to you and then you as the platform are giving me dollars, I'm going to have to put in my bank account details, and I don't know how easy it is for companies to send people money. I think it's just a lot more friction, right? It's a lot easier to just have a token there that is intrinsically backed by the money that you're making from the people buying the data and then rewarding the users with that token. Now, balancing the supply and demand and some other features within that is a bit complicated, but that's why you have us. But also you just mimic basically an existing economy, like a macro economy, and then just dull it down to a micro scale, and you basically would understand how a token can be used to build that relationship between the company and the user, if that makes sense.
Yeah, really. So no, you were saying earlier, it's like air miles almost for an airline, right? So you always fly with airline A, you get the airline miles, and then I guess what would so then why would you choose a token over one of those sort of established systems? Is it just because it's then easier to trade with somebody over a DEX or whatever? How you actually share it with someone? Yeah.
So from the perspective of the company, do you mean why would the company choose to implement a token rather than the existing? Yeah. So, and this might be a clippable thing here, but basically because they just don't realize that will okay, how do I say this? Fundamentally, there's no reason, right? You can just use air miles, right? However, you might think that you want to improve the user experience, so therefore you will allow the users to also sell that token elsewhere, or maybe give that token more utility, like some sort of revenue share, but then you'll have to register as a security, but nonetheless, or utilize it in governance, or maybe even staking. I don't know what it is, but a token can be utilized in a lot more ways than just the air miles sort of thing, right? It's a lot more versatile. So if you have other utilities, then that you can think of that will improve the user experience, or the UI or whatever, then implement a token because it's better for the user, right? For reason X, Y, Z. However, generally speaking, and this is the big problem in Web3 that we're trying to solve at Simplicity, is that most projects launch a token purely so that they can fundraise and basically give staking rewards and market and bring users onto the platform, right? So they don't actually need a token. We've rejected a lot of companies that have come to us and we're like, we want a token for this. And then we tell them, you don't want a token for this. It doesn't make sense. You only want a token to raise some money so that then you can likely exit scam, right? Or just rug the project. That is pretty much why a lot of companies are implementing tokens, sorry. And after speaking with a couple, I don't know if I can say the name, but some very high up VCs in the space, we found that there's a consensus of when you should implement a token if you are, if you're just a company that wants to have a token to increase or to benefit the user, right, to increase the user experience, and that is, you have the company, you have the product, people come onto the platform, they use the product, everything's nice and good, and then you implement a token once you already have that user base, and then that token is a very smooth, it comes in and then people can use it, but you don't implement it from the start, you don't implement it from the get-go just so you can fundraise or anything like that. And this is an example is Reddit, right? Reddit, they have their NFTs and they have their tokens now, but they already had the company there, so they're not attracting new people to to their platform just so they can earn like a yield or anything like that. They already have the users there, and they just have the token to increase the user experience. So yeah, just to answer your question, basically there isn't really any need in the vast majority of cases to have a token. It's just people want to fundraise with it, and then the VCs, most of them are just people who got very rich during the bull market and decided to register a company. So they don't really understand tokens either, so they'll just invest if they see like 5 utilities, even if the 5 utilities are staking 2.0, staking 3.0, governance and staking. They'll still invest because they see 5 utilities, right? So that's basically where the crypto space is at right now.
Yeah, because that's one of the things that I see with a lot of them, and it's like, you know, you've got these brands, like you said, they launch they don't launch the business, they launch a token that the business is sort of attached to, if that makes sense. And the whole idea is just, we're going to have this token, and then later on we're going to do like this kind of stuff. But really, it's just the token that they're launching. They haven't got like a business plan or anything like that. And so, you know, those ones,
exactly.
From what I've seen, they don't last long because there's no value in the business itself. It's just as soon as the value of the token starts to dip, that was the entire value. It's gone. You know. So
exactly.
Is there? And you said, like, you know, you got like Reddit as a good example. You know, they got the user base, and then they introduce NFTs, tokens, any sort of digital asset. Is there sort of like that point that you look for in your consulting clients? Like, do they have to have hit a certain level of scale, or is there something that somebody should consider when trying to implement? So, like, when is that right time to start thinking about it?
Yeah. So, just to touch on that very quickly, a project or like company can launch a token like at the same time as they launch their product, right? However, we always say, and we try to work with clients that already have some sort of proven history, like they already have 100 users in the beta test, right, or whatever, but they have some numbers that they can go with. Because if you have nothing, and then you're saying, we're going to launch a product, and then it will attract 1 million users, that's nice. It's not going to happen though, like fundamentally. So then, so to answer your question, in fact, can you reiterate your question one more time, just so on point?
Yeah, just like what's that sort of point where, because, you know, you say you've got to have some users, so is there like I know it depends on the business, there's no magic number of like, you've got to have X number of users, but is there a point of certain level of scale or something, or traction that somebody should be getting at and thinking, right, now maybe is a right time for me to consider this?
Yeah, I guess the term for that we are sort of using with these high level VCs is like critical mass. Now, again, as you said, exactly, it very much depends on the business where that point is. Like, for example, for a layer 1, that point can be literally even with like 1 user, because your layer 1, like, you need a token from the very beginning. You can't have a product without a token, right? However, if you're like a company, then it's just sort of, how do I say this? Like, it can happen whenever, right? But it's when it just feels right. It's like when the user growth starts to plateau a little bit, maybe when it starts to slow down, maybe when you've already captured one market that you're aiming for, like before you expand to other markets. Like, it just depends. But fundamentally, also, sort of touching on what I said in the previous point, is you can launch a token beforehand, and like before you reach this sort of critical mass, right? But you just need to ensure that you balance the supply and the demand, right? And that's why we want to work with clients that already have some sort of like user base, even in the beta test or whatever, because we can then extrapolate the demand from that and therefore balance the supply side of the tokens, like with the vesting schedules, with the different allocations, the different tranches and so on, with that expected demand, right? So as long as you can balance the two, and what all that does is it just keeps like the price constant, right? So as the supply is increasing, the demand is also increasing. I don't know which way it's going to be. And then, you know, your equilibrium price is kept the same, right? So as long as you can do that, like, you can launch a token before you've reached the sort of critical mass, or maybe even from the get-go if you have some sort of users or like some experience. So maybe you're just rebranding a company. I don't know, right? But generally speaking, it's better to launch a token like in the future stages, because one, you confirm that you have a product or service that people actually want to use, right? You're not just, as you said, it's not just a token, and the token is the whole value of the business, right? You actually have something there. So you confirm that, you have all the users, and then you're like, cool, well, you're looking at our data, a lot of people, they like to leave, you know, comments on each other's posts, but they don't actually care about voting for how to improve the, you know, the company, right? So therefore, if we were to launch a token, we're going to ignore governance. We're going to focus on a user-to-user sort of medium of exchange. So it also gives you that ability to launch a token with the right utilities that actually improve the user experience.
Yeah, I guess, and from the sound of it, it's more like it might be a good time to consider implementing a token when you've got some level of predictability on growth, because otherwise balancing supply and demand is going to be a right pain in the ass. Like, how are you going to, if you don't know how many new users you're attracting or how long lifetime value or, you know, your churn rate or anything like that is, then you risk introducing it and it's just going to collapse on you, right?
Precisely.
Got it. Okay, cool. So then, like, what would be like a good and a bad use of a token? I mean, you've talked about some, like, what, I'm just curious, like, what are the worst token uses that you've seen?
Yeah. So we, one of the things that we do at Simplicity Consultancy is we release not quite a lot. Like, we have about maybe like 10 or so one-pages that explain like tokens and how we view them. So I have one up on screen. I can share it as well after. But the way that, like, there isn't necessarily a bad token utility, right? It's just how it's implemented. And also, it can be bad for some businesses. It can be good for others, right? But the way that we look at it, like the core of it is we split token utilities into primary and secondary utilities. And again, this isn't really something that I've seen personally anywhere done before. And a primary utility is something that actually necessitates the creation of the token. So for example, consensus mechanisms, like that proof of stake thing, right? A medium of exchange whereby you don't want to use dollars and you also don't want to use Bitcoin because who knows, Bitcoin can be, 51% attacked, whatever. You want to have your own currency, right? Cool, fine. It can be used as a debt instrument. It can be used with, like, as a better version of a security. So like revenue sharing and this and that. It's used for fiscal and monetary policy control. And last but not least, governance as well. Governance, again, like I joke about it, but it's arguably a good utility if it's implemented correctly. Right, so these 6 things are something that we've identified to necessitate the creation of a token. And arguably they're all good utilities, but again, like, you're not going to need for example, you're not going to need to have your token be a security token with like revenue sharing if you are using it as a, I don't know, like a layer 1, proof of stake token, right? Like it all depends on your business. And then you have the secondary utilities like staking, gatekeeping, and rewards, right? There's probably a few others, but these are the main 3. And the reason these are secondary is because you don't need to create a token just so you can reward users, right? You don't need to create a token just so you can gatekeep some parts of your platform from users who don't have your token. Like you don't need a token for that. You can use other things. You can use like a login account. You can just charge people. Like when it comes to rewards, you don't need to reward users. Like, you can just have a good product that people are using. Like, if you're rewarding users for just simply using your product is probably quite bad, right? Fundamentally speaking, in layman's terms. Obviously, it makes sense in some cases, but it doesn't in others. So, like, I guess to answer the question is, it very much depends. As long as your token is used to improve the user experience, and again, to like benefit by extension also your company, then it's a fine utility. But if it's used for purely like the secondary utilities that don't actually need the token, or for the sake of, well, like fundraising, it's not going to be a good token. So I hope that sort of answers it.
Yeah, but I guess I'm thinking, and I'm going to show how skeptical I can be. I guess when a company is like introducing a token, they've got to try and plan for the worst potential people. Because like you were saying, if you're incentivizing people to use your project and you're just simply rewarding them just for usage, I imagine that a lot of people are going to come and just use it just to try and farm as much of the token as possible before they can then go dump it somewhere for...
Yep.
Was it? And I guess that you've just got to try and be very skeptical on the future potential bad actors that a token might attract.
Yeah, of course. But also, like, this is exactly the topic that we released on our most recent one page about staking. It's, you need to figure out who you're actually rewarding, right? If you are For example, right, if your utility is governance, and then what you do is you charge fees on people using your platform over here, like a 1% fee, 2% fee, and then let's say half of that is going to go back to rewards to people who, let's say, stake to govern the platform, and then their proposal gets implemented. So everyone that's staked and like governed for that proposal, and then this proposal done well for the platform, they get rewarded. That's a very nice and fine system, right? You're rewarding users who are being helpful to your platform, and you're just implementing a little tax on everyone else, generally speaking, right? Yeah. That's fine. However, if you're literally like, if you just have a staking thing where I can buy the token, I can come on and I get 20% APR for just staking, and I get more of your token, all that means is I'm going to keep staking and staking and staking until I see, because obviously what that does is it locks up the liquidity, right? And because you have less supply, the price will keep going up. As soon as I see the price go like just a little slow down, that's it, I'm out, right? I unstake and I cash out, and so will every single other staker, because they were only there, as you said, to take the token and cash it out. They don't care about your product, right? And this is also something that kills the vast majority of projects, because that is literally like, they have this user acquisition strategy and it's fine, but again, you need to make sure that it's balanced, and you need to make sure that you're attracting the right people, because otherwise you're just going to attract vagrants fundamentally.
Yeah, well, that's I remember, I think it was last year sometime, I remember Twitter was blowing up, and like a ton of people that I was following on Twitter were getting involved in, I can't remember the name of the projects, but basically it was like you'd end up paying about $8,000 for a block, and then you could stake that, and then you get more and more and stuff like this. And people were like, oh yeah, I've got 7 blocks now, and they're providing me with this much profit every month. And I was looking, I was like, I don't understand how this works. But eventually, as you said, those things where you just stake some money and you get massive returns, eventually they all just seem to run out of steam and just die a death.
Yeah.
But I'm wondering, so like,
yeah, they do. I've learned the hard way.
There's somebody who I think a lot of us have.
The hard way.
But like, as like a user, if you're going into looking at these projects, like a lot of people won't have the knowledge that you do to go and like fully assess the tokenomics. Is there like a key red flag that you should look for as a user to be like, nah, this is not something that I want to put my money in?
Yeah. So the easiest thing that I would say as a very quick and easy red flag to spot is how much, because like the tokenomics tables, so it's like 10% to the team, 10% to VCs, 10% to governance, whatever. Those are generally speaking public. So if you see a project with like the vast majority of the tokens, or even just a simple majority of the tokens going to the team and investors, generally speaking, anything over like 20% for each is a bit too much. Again, it depends. If the team is huge, that's more understandable. If the vesting schedules are very long, understandable. But roughly speaking, right, if there's a lot of allocation to those two categories, it's a little bit, it's quite a red flag, right, when it comes to just thinking about who's the protocol having creating the token for, right? Is it for the benefit of VCs and to fundraise and then to cash out as the team, or is it to reward the users, or whatever it is, right? So that's the first thing, like a very quick sort of an easy thing to spot. But then another thing is, I suppose, a more deeper understanding of what the project actually is, and then seeing, cool, can they use dollars to do this? Can they use traditional Web2 things like air miles to do this? Can they use, I don't know, NFTs to do this? If they can use other things to achieve what they're saying the token utility is going to be, then it's not going to be a great token, and eventually it will all come crashing down, roughly speaking, right? Because the token, again, will have no, like, it'll have intrinsic value, but is just, you just have to question whether the team actually knows what they're doing with the token. Because if they can implement air miles, but instead they're implementing a token and obviously taking, giving 20% to VCs, then it's basically just all a massive conflict of interest. And if you can spot a company that has a token for a good reason, I know that's a bit hard, but like, yeah, like you can have a gut feeling of whether the token is going to be used to benefit me as a user or to benefit the company or the investors. I guess that's like a more overall way of looking at it.
Yeah, I think that's right as well, because you look at some of them and the gut feeling is like, I don't understand why they're doing this, and if it doesn't
Yeah,
make sense,
yeah,
like,
those,
yeah, even if it's a personal thing, why would you get involved in something that you don't understand or don't really believe in?
Yeah, precisely.
But then I guess for the projects we're introducing these, like you said, I think the allure is there for like these projects because they see, and you were saying like, I remember all through 2021, 2022, you'd see these projects and they'd, spin up on a Monday and by Friday they'd have 100,000 users or something because they had these ridiculous tokens or these ridiculous sort of staking like plans where you would do a little bit and you'd get like, a huge return. Is there anything that's never going to work, but how does a project balance the sort of short-term growth that a lot of them want with the long-term benefits that are actually going to keep the value in that token? Like, is there anything there, or is it just really just play the long game and hope,
generally speaking, it is. Yeah, like generally speaking, is played the long game. Those are the type of businesses that survive, and fundamentally, projects in Web3 are just businesses. And this is something that I noticed as well, a little bit of a tangent, but like just because in Web3 they're called projects, they're still a business. But for some reason, a lot of people just think, oh, this is just this magical thing with this magical money, and it doesn't need to have revenues, costs, none of that. It'll just work out because we have a token. It doesn't work like that, and it all comes crashing down eventually. But it's bringing you back from the tangent. So if the majority of your users that you're attracting to the platform are being attracted via like high APYs or whatever, like if that is where all of your users are coming from, for you to then be able to keep those users and to actually, continue the sustainable business, you need to, one, convert those users or convert those stakers into being actual users of your platform. And then two, you need to ensure that you limit how much the people who aren't being converted can damage your protocol. So on the former, a bit difficult to do because, again, you're just attracting people who are coming for the high APYs and aren't actually benefiting your platform realistically in a lot of ways other than, holding liquidity and therefore pumping the price of your token, which again is fine, but you need to have a plan in place on how you're going to convert that into actual users, right? And one way of doing that is by attracting people that you would think would be users from the get-go, right? And then just offering them this high APY. For example, if you're a gaming project, you reach out to, gaming influencers or something like that, and then you attract the gamers that will already be interested in your product, but you just entice them with the high APR, but you keep them with the product that they'll probably like a lot, right? So you need to basically figure that out, how you're going to convert them. And then the second thing is the people that you don't convert, you implement things like locked staking, like unstaking fees. Like for example, lock staking, you can like lock the staking for 30 days, and then if you want to unlock it, like unlocks 10% of your stake every week, right? Something like that. And then that will already reduce the supply. You're not going to get like a sudden supply shock, right? Two, so for example, you have unstaking fees. Like you can implement a feature whereby users can come on, they stake your token, and then they earn more of your token or whatever in which way, either taxes or it's being minted or it's being bought back and then redistributed, wherever it is. And then they have a choice. Either they can, like the tokens they're locked from being taken out and onto an exchange, but they're unlocked within the protocol, if that makes sense. So then if you're a game, then cool, I'm earning all these tokens and I can spend them in the game. I just can't cash them out without paying like a 20% tax or something like that. Something like that will also reduce like how much of the supply can be, how do I say this? Basically, how strong the supply shock will be once people actually, try to cash out. So I guess is that fundamentally, and also it's just balancing the supply and demand. Like if your utilities are pretty bad, like if no one actually needs to buy your token, like for example, exchanges, I never have the KuCoin token because I know it saves me like 50% of the fees, but the fees are already like 1%, so I don't know, whatever it is, but like I don't care. I'm not going to buy the KuCoin token and hold it, right, for that reason. Maybe it's because my account isn't big enough, I'll give you that. If your account is like, 1 million, it's definitely worthwhile. But not for me, right? So like if that's, for example, your only utility, then not a lot of people are going to buy your token, right? Generally speaking, right, in layman's terms, as an example. So if you attract people with this high APY, like you're not really going to get people demanding the token outside of that, right? So that's something else to consider. You need to have like good utilities for the token, so that then as your users grow, but like not just stakers, but actual users, people that are using your platform, game, whatever it is, they would need to buy the token, or they would want strongly to buy the token for reasons X, Y, and Z. And therefore, like as people are on staking, and like you're dialing down the whole staking user acquisition strategy, you're dialing it down, or you're reducing the APY, or just stopping it, or whatever it is. Like that sell pressure is being taken on by the user growth that you're getting and all these users demanding your token. Again, just balancing the supply and demand. And if you already have like some like users on your platform and you can see how much you've grown, like you can see, let's say marketing strategy A and marketing strategy B yielded us 200% of the users. So therefore we'll do that again, and then we'll get like another 200%, right? Something like that. You can work out and you can do some rough maths about how much demand you're going to get versus how much sell pressure you're going to get. And then you just balance the two out. Like you maybe, you reduce the APY slower. Maybe you can reduce it faster because you have some great strategy in your back pocket that will just attract 1 million users overnight. Like something like that. But it's yeah. Hopefully that answers.
Yeah. It sounds like it would be like that. Sounds like it would be a real pain in the ass to try and get done. Like if you've got people who have come in because you've got these ridiculously high APYs, to try and convert them, then that sounds like it'd be a real nightmare. Because I mean, those people, they're just going to be going from project to project that's got high APY. As soon as they can benefit off it, they're gone, and they're on to the next thing.
Exactly.
So I guess then, if you take everything that you said together, I guess projects maybe who might be considering some sort of token, wait until they have some form of predictable growth so that they can better judge how things will work in the long term. Have that long-term goal, and focus really on sort of the utility of it that is not something they could do with existing solutions. Yeah,
just to touch on that, it like a token can just be a replacement for existing things. I guess I didn't really clarify that earlier in the episode. Like the way that I see it, and this is sort of a philosophical side of things. We had gold back in the day where it was just one currency basically for the whole world, right? It was just gold. Again, in very layman's terms. Then that got sort of split up into each country having their own medium of exchange, their own currency, like fiat. Again, very layman's terms. Now we can take that a step further, right, and go into a world, like there is a world, arguably somewhere out there, where each company, each community, everyone has their own currency, and it's just all Forex across the whole world, right? That isn't really that unfeasible if you have like good exchanges with like a lot of liquidity or this or that. Like it's not, like it's possible, right, given the right tech. So with that in mind, if you just want to have a token as a medium of exchange, knowing full well that you can just use dollars or you can use Bitcoin, but you want to separate yourself from potential risks of those things going down or like hyperinflating, whatever it is, then it's fine to implement a token. But it's just like you need to explain that in a way where it's not going to come across as if you're just, having a token to fundraise again. Like it does make sense to have a token to just decentralize yourself, like, from all these other things which might go down. So yeah, that's something to like keep in mind if a project is saying that they have a token and like the token is doing things which can already be done with like Web2 things. Like that there is a reason for it still existing.
Yeah. It's more like getting people more invested in the company, I guess, as in not financially invested, but sort of emotionally invested because they hold some form of a stake in the company, whether that is ownership or governance or whatever. Cool. Yeah. And then I guess anybody who's considering doing a token, I guess anything they can do to future-proof themselves, because I know like the whole idea around tokens as securities is an issue for a lot of people, and I think I got some comments from somebody yesterday who was chatting to about this, and they were just like, "Oh yeah, but Their view was, and they're not a believer in Web3. Their view was that the US government's going to ban Bitcoin and all of this, and
you can't.
pain in the ass. I think really what they're talking about is actually just talking about tokens as securities. I'm just wondering what brands could do to kind of help prepare themselves for that.
Yeah. Well, fundamentally, it is good for the government to get involved and to prevent users from, or like people from, losing money. And the reason why securities even came about, right, is from American. There was a guy called Howey, and I can't remember the story exactly, but that's where the Howey test comes from, which I'll explain in a second. But basically, the guy, it was something to do with like an orange orchard or something, but like he couldn't, I don't know, like sell parts of the farm, so he sold like futures contracts, something along those lines. I can't remember, but basically he just scammed a lot of people, right? Fundamentally. So what the government decided to do is then implement the Howey test to determine whether something, well, like an asset, is a security or not. And the Howey test is basically 4 points, but it's all like sort of one sentence. And I'm going to get it out so I don't butcher it. So give me 1 second. But it used to like just roll off the tongue, but I haven't said it to a lot of people. All right, cool. So it's, if an asset passes all 4 things, like to all 4 things it's a yes, then it's a security. So it's an investment of money in a common enterprise with the expectation of profit to be derived from the efforts of others. So the first 3, pretty much everything falls under. It's just the 4th thing that really turns something into security versus just an asset, right? And what that means is, for example, if like revenue sharing, right? If you are making 15% revenue share, if you hold this token, that revenue share is coming from the company, i.e. the third party in this case, doing very well and earning a lot of revenue. So it's their effort that is then being reflected in the profit for the asset, right? So that would be a security. However, if your token is purely used as a medium of exchange, i.e. it's not meant to go up in value, it can if there's a lot more demand than supply, and that's fine. But that's not due to the efforts of others. That is like, it's written in the code. That's just how it is, right? Then it's not going to be a security, right? Like another example is if you implement a burn mechanism, right? And this is something that we got from our lawyer, who's, again, don't know if I can reveal who it is, but from our lawyer, working very closely with security stuff. What he said is, for example, and this can change, but like, oh, actually, sorry, just before that. So the Howey test is in America. In the UK, it's very similar, but it's all case law. So it's like, it's very case by case. So you don't really have like a very flat out test. But generally speaking, it's the exact same thing that determines whether something is a security or not. And it's roughly speaking the same in like Europe and other places around the world, right? Circling back. What the guy told us is, if you have a burn mechanism, for example. Burn mechanisms are there to reduce supply and therefore increase the price of the token, right? By themselves, a bit of a pointless thing to do, because all that means is that you're just artificially going to be increasing the price, right? So it's not really, that's actually another little red flag. If they just have a burn for no real reason, it's not, it just means that you miscalculated your token price, right? And you just want it to go up in value rather than to intrinsically provide value to the users. But anyways, if you state, like in the code, in your white paper, everything, you're going to have a 2% burn on all transactions. That's fine. That's not going to make it a security, because like it's written, it's not going to be derived from the efforts of others. It's in the code, right? That's just how it is. However, if you have like an ad hoc burn, so for instance, you will burn, like the team will decide how much they can burn based on X, Y, and Z, then that could make it a security. Well, that will make it a security. Again, it can change, but generally speaking, right now that's the case, because now it's like the team's effort that will then affect the price, right? So in order to future-proof your token from being like under the regulators' eyes, once those guys have everything figured out and actually start to, look closely at crypto, because at the moment they're not really doing anything. They're just allowing, everyone to do whatever they want, roughly speaking, right? Unless you're very, very big, like Ripple or whatever else. Everyone can do what they want at the moment, right? But that will change very, very quickly. I'm expecting like within 5 years, we're going to start to see some real changes. And that's like my personal maximum, right? But yeah, to avoid falling under the hammer, right, of being a security. Just don't have an expectation of profit to be derived from the efforts of either like the third party, right? Fundamentally, it's just as simple as that. And this is the difference. You have utility tokens and you have security tokens. Security tokens generally are meant to go up in value, or they're meant to provide like profit back to whoever owns them. Utility tokens, they're just there for utility. They're not meant to go up in value. They're not meant to give the user any profit, any revenue. They're just there, like a medium of exchange, or maybe for governance, or maybe for staking, like as collateral, or maybe for like debt, whatever it is. But it's a utility, and those tokens are fine. At the moment, that's the general gist of how it's going.
Okay. Yeah. So from some of it, it's I guess when you create the token to write into the contract how everything's going to work, and then not take any decisions on like burn mechanisms or how the value of the token is going to change later down the line. That's one way to kind of not future-proof yourself, but to give yourself,
generally speaking,
yeah. Okay, cool. So I guess I mean, there's nothing else that I thought would really want to go over today. I don't know if you've got anything that you want to add.
To be honest, not necessarily. I guess what I'll do is I'll just reiterate everything that I said in to anyone who's listening that isn't like involved in crypto, or isn't like full-time crypto, and it's that a token is just a vehicle to transact value. That value can be monetary value. It can be like the feeling of being a part of something. It can be collateral. It can be votes. It can be whatever it is, right? But it's just value, and you use a token to transact that value, because other methods are either too inelastic, or they're just not good enough, or they can be attacked or hacked, or they're controlled by the US government rather than by the team who's creating the token. So that's the main thing. And when it comes to working out whether a token's good or not, just look at whether it makes sense. Generally speaking, if you're looking at a project and it doesn't make sense, or like you're thinking, oh, how are they going to do that? And they're not really explaining it, is because they don't know and they're just lying. Generally speaking, 99% of the time, right? So avoid those projects in general. And then if you're a project and you want to implement, utilities or staking or this or that, just make sure that you have an understanding of how much users you're going to get versus how much of the token you're going to supply, and then what the users would want to do with your token, and then implement those utilities to improve the user experience, and avoid giving more than like 10 to 15% to VCs, because that's just sell pressure that doesn't need to be there, arguably, and just focus on the user, basically. So yeah, I guess that's sort of a very nice way of summarizing everything.
Yeah. Cool. And then we'll pop all of the links and everything where people can find you if they are at that point where implementing the token makes sense, or they want to come chat. But yeah, I guess that's it from me. So, thanks for your time.
Yeah, absolute pleasure. And thank you for having me on. And open to have any chats with anyone in just DMs or wherever it may be.
Perfect. All right. Cheers, Alex.
Cheers, Pete.